Let's switch gear a little bit and talk about capital raising. I know in addition to being a lender, sometimes you also go on deals, whether it's JV or co-GP of sorts. Share with us a bit about that. What is your buy box like? When do you decide whether or not you're going to get involved in a deal beyond the lending side of it?
Yeah, so actually, there are two aspects, right? If a property is already stabilized, my rule is and has always been that if you're not able to get at minimum 75% loan to value from a permanent lender like a Fannie or a Freddie, then in my view, one would overpay for that property. So that doesn't mean that one should actually take out a 75% LTV loan, but at least it should underwrite to that level. So unfortunately, we have seen that many times where it doesn't underwrite to that, and today that is the case. So that's one of the criteria for me when it's a stabilized property. When it comes to value add or distressed properties, that's obviously much strict. I would say we definitely have tightened that side significantly. I would not go into any deal unless it's where we personally live. Obviously, we live in Dallas Fort Worth, or in another market where we have a partner we can trust 100% that they are truly the boots on the ground there. And I'm not saying just let's do a little bit of asset management. They need to have very strong experience and position in that market. What we see a lot is, and we just saw yet another syndicator who has had plenty of trouble in the past, but now they are going for a 3 or 4 property portfolio that is spread across several markets. In my view, that's insane, right? This is essentially bound to fail before they even start because you cannot have the boots on the ground that are really able to support these deals. So that is really my two main criteria. The boots on the ground is really non-negotiable, period. I've seen it now so many times where someone attempted to be in a market where they do not have a strong local presence and it just doesn't work out, particularly in the current environment. Asset managing from the beach, unfortunately, while it sounds great, it's just not feasible.
Gotcha. Let's talk about fund of fund and fund of funds. You distinguish the singular and the plural in that. And I know you're not a big fan of fund, the singular form. So first, if you can share with everyone the difference between those two and why is it that you don't like the fund of fund part of it?
Yes. So when we talk about funds in general, right, what most people would understand of a fund, oh, I invest in a fund, that they invest in a fund that is providing them with diversification, right? So
Right.
whether it's a mutual fund, whether it's a ETF, whether it's a REIT, whatever it is, that's what generally most investors would associate with, right? So rather than me picking different investments, I invested in a fund and then I'm immediately diversified in that segment that I want to invest in. And that, in my view, is a very good strategy, right? As an investor, invest in one vehicle and have that diversification right out of the gate. Now, when it comes to that fund of fund model, which obviously is really very unique to the syndication space, where you essentially have someone offering an investment in a single asset and then that investor invests with the fund, which then invests in a target asset that is also a single asset. My question is, what's the benefit for that investor, right? So now, obviously, there are arguments. The fund manager of that fund of fund will do the due diligence. Maybe they will be able to negotiate better terms thanks to a larger sum that is being invested by that fund compared to the individual investor who could not get the same terms. So there is that argument, and I'm not discounting that argument. My main problem with those structures that most fund of fund managers do not really have the ability and capacity to do the true proper due diligence because the fund size is just not large enough to support that. And on top of it, they just do not have the necessary background to really be managers that are capable of to do deep due diligence. Now, also, if there is anything going wrong, now the investor is one level removed from the target fund, which is another negative point. And as there were a couple of situations where it didn't work out well, and investors in the fund of funds are now removed from the target asset fund, which makes it much harder for them to get the information and to get any view of how they can get out of that situation. So this is really why I'm not really comfortable with these fund of fund models. I know obviously you are very active in that space. If it's done, I think it can be done correctly, but we also need to recognize that it's also about economics, right? Particularly if you have let's say you raise 3 million or 5 million for a single target asset, the cost to do proper due diligence is just, it's comparatively high. And to do ongoing management and monitoring of that for just, let's say, 5 million is just very costly, right? If it can be spread among a larger portfolio, it is much easier to absorb.
And yeah, I know a lot of times in our single asset SPV fund of funds, a lot of times it's under $1 million. So it's even more high.
Yeah.
And yeah, so that's one of the things that we do is we have a few fund managers who would partner with each other, become co-fund managers and help share in some of that cost and be able to do better due diligence. Like whoever might be boots on the ground is driving there, doing the actual due diligence. And by collectively coming in together, we usually get a lot better economics than any one fund managers can get on their own a lot of times. Yeah, we do work our best to try to solve the issues that you're referring to with yeah with this side of fund of funds. And
Yeah,
yeah,
I
we
mean
yeah.
that's good to hear. I don't appreciate that you bring up that topic. Obviously, it's a sensitive topic, particularly for you, since you are in that space and you know that I'm pretty critical of it. So I really appreciate that you bring it up. Again, there are good players and there are bad players, right? And the problem is that the bad players are ultimately causing this space to blow up, as it
Right,
is with any type of area, right? With the
right.
bad players in any area, even when you look at crypto, you have a few bad players and it creates a massive issue for
Yeah.
everyone else. So only in that space, I just have seen so many fund of fund managers that all what they did, they took the target assets pitch deck, added another page with their resume on it and their logo, and it went out to investors. That's not due diligence. That's essentially just being a marketing machine for someone else. And some of these fund of fund managers, I know that they do not really understand enough to do proper due diligence. And that's really where the risk that I see, and obviously it damages everyone who is doing it the right way.
Yeah. And then some of these issues too, there were similar issues in the coach GP model prior to the fund of funds model getting more popularized. And so, yeah, it is definitely educating the marketplace on the right way of doing things so that way we don't ruin it for all of us.
A very good point, right? So I'm not saying that there were no issues on the coach EP side, right? So there are plenty of incorrect ways people were raising money through coach EPs, right? So I'm not saying that one side is only good and the other side is only bad. What I would say is if someone has such a challenge to raise money for deal sponsors, what they may have to consider is and ask the question, is the deal that we are targeting just too large for us to swallow, and should we scale down? Right? whether it's through a co-GP or through bringing in a fund of fund or multiple fund of fund operators, they really need to ask themselves, is this because we are just biting into something that is way too big? And that's what I would recommend for syndicators, really to think very hard whether it's worthwhile to go for some of the larger deals or just scale back a little bit, so it makes it easier to actually raise money rather than stretching at every corner and potentially even entering some form of a space that is gray zone to all the way legal.